Hello students, welcome to day number 2 of the practice to pass sessions being conducted by ACCA. Assalamu alaikum and wa alaikum assalam. So let's first of all begin with the question which was pending yesterday, BESRIL, the capital rationing question. So a few requirements from that question were left. So let's first complete those requirements. So let's first read the requirements. The requirement B, explain how the NPV, investment appraisal method, is applied in situations where capital is rationed. So what the question is asking about is when capital rationing is applied means that the funds are short. The company is not having enough funds that it can invest in all projects which have a positive NPV. So they have to ration it. Ration it means you have to justify it and put the funds in the best use. Means in the projects which will generate the best level of net present value, right? So let's discuss how they will treat them. So we have already discussed a few points regarding this in the last class, that when there is a capital rationing situation and funds are short, there are two types of projects. One of them is divisible project and the other one is indivisible project. In case of a divisible project, we use the profitability index method. We calculate the net present value per dollar and of a project, and the project with the highest net present value per dollar is selected first, then second, third, and fourth. Likewise, we continue investing in uh, uh, the rank which is given the priorities. Okay, now in the case when the projects are indivisible, means they cannot be divided and they should be fully purchased, we have to use the trial and error method. We have to make combinations as we made in this question uh, in our last working. So which combination did we select? We selected P1 plus P3 because it was generating, as you can see in the blue row, 110,531 NPV in the combination. So that was the highest possible NPV which we could have generated, right? So let me give you a small chart showing this rule. Now you can see on the screen a small table that discusses this rule being discussed by me a few minutes earlier. So please look at the golden block displayed on the screen. In the golden block, you can see two things: types of proposal as to its divisibility. So if the projects are divisible, a portion of it can be acquired. You'll be using the profitability index method, NPV divided by initial investment. And if the project is indivisible, then you can see in the blue circle, indivisible projects, trial and error method will be used. So this was the rule. Now, one more rule is to be discussed over here, and that rule is that whether the fund shortage is in or continue in future, as it won't continue in the future, in that case we will be using a single period capital rationing. So the rules we have considered and which are in our syllabus, in FM syllabus, so we are being tested only the single period rationing, And if there is a multi-period rationing, in that case, either linear programming or simplex method will be used. Both of these are not to be examined in our syllabus, right? So we have not discussed these two methods. We have just discussed the profitability index and trial and error method. So that's the answer to this part, right? Now let's move on to the next part. So moving on to the next part, I'm reading the next part of this question, part C. Discuss the reasons why capital rationing may arise, the reasons why the funds shortage arise. This is what they mean to ask. So I'm giving you a chart for this as well. Please look at the table on the screen. You will be able to see a tree diagram in the yellow patch, right? So this tree diagram discusses that why do shortages arise? Why do the fund shortage arise? So the fund shortage may arise due to some internal reasons, which is known as soft capital rationing, or it may arise due to external reasons, means creditors and the shareholders do not want to invest funds in the company due to either a high gearing ratio, or the shareholders uh, are estimating that the projects are very risky and there is a big operational risk, therefore they are not investing in the company. Or the stock market may be depressed, conditions may not be good in the stock market, so these may be some reasons behind hard rationing, that people are not investing in the company. And the second reason is soft rationing. Soft rationing means here the management internally do not want to raise further funds. They have put the limitation themselves. One of the reasons could be the one I'm ticking, that's management wants to focus on few quality proposals, mainly to maintain control and quality. They don't want to do a lot of work and spoil the quality. One. Second, management is not capable of undertaking and running too many projects. And third, capital expenditure budgets may limit them to obtain further funds and to invest in professional. Why companies put limitations on raising further funds themselves? Okay, so this was the answer to the part C. Now moving on to the next question, which is on lease or buy decisions. So next topic which will be covered is lease or buy decisions. So students, question number 7. Please go through the question. Let me give you a little bit of the background regarding the question 7, that what this question is covering. First of all, the question covers that when the company is investing in a project, in a new project, it will require funds. So it has two options for generating the funds. One of them is that it can borrow the funds. Now suppose the company borrows funds from a creditor and it purchases the machinery or the equipment or the factory involved in the project outright, and it becomes the owner of the assets. So one is this option. The other one is to obtain it on lease, on rent. So it obtains the assets on lease. So if it obtains the asset on lease, in that case, the lessor will not transfer the title to the company. So company will not be the owner of the assets. So what happens that if the company do not become the owner of the asset, it cannot claim tax depreciation and it cannot deduct tax depreciation from the taxable income. Instead, it will be able to uh, claim the installments being paid from the taxable income. And obviously, if they deduct the installments from the taxable income, they will be able to save some tax payments due to this deduction of the rental amounts. So if we compare this lease tax benefits to the situation when the asset is being purchased outright through borrowing. So if in this case, when they borrow the funds and, and purchase the asset outright and become the owner of the asset, they can claim tax depreciation. So if they can claim tax depreciation, they can deduct it from the taxable income and they can save some money. But obviously there will be some difference because the tax depreciation amount per year will be different and the rental amount will be will be different in case of lease. So in both cases, the tax savings will arise on uh, a different timing. Obviously, the present value of the tax savings will be different in both cases. Secondly, in case of buying the asset, the lump sum amount will be paid immediately at year zero to purchase and get the ownership. And in case of lease, the payments will occur gradually, like annual basis. So this will also be difference. Again, this may result in time value of money differences. So we'll be comparing the cash flows associated with the lease and the cash flows associated with the ownership of the asset in order to know that which option is cheaper to you, whether to borrow or to lease the asset. So, okay, students, please go through this question. I will scroll the question down slowly so that you can go through it comfortably. I'll be starting in around 2 to 3 minutes time to solve this question. Okay, students, let's first calculate the present value of the cash flows that are associated to the lease. And then we will calculate the present value of the cash flows that will be associated to the ownership of the asset connected to due to the borrowing option. We will be able to become the owner, and in that case what will be the present value of cash flow we will see afterwards, right? So let's start calculating the present value of cash flows associated with the leasing arrangement. So what they say that due to leasing they will be paying 3,80,000 per annum, and the payment begins immediately at the start of each year. They have to make the payment immediately, right? And the licensing requirement to use this asset is included in this 3,80,000. So they don't have to pay the license fee separately in case of lease, but in case of ownership, they have to pay it separately. Okay, and they will be able to save 30% tax if they pay this 380,000 annually. So they will be able to deduct this 380,000 from the taxable income, and they will be able to save some taxes. So let's do this working, that how much will be the cash outflow due to the lease payments and its present value. Okay, so I'm starting to work on it. So first of all, calculating present value of cash flows associated with the leasing arrangement. Okay, students, in case of lease, they have to make the payment immediately. So there will be total 4 payments. This is a 4-year project. So the first payment will occur on year 0, then on year 1, 2, and 3. So from 0 till 3, 4 payments will occur, and these are the lease rentals that will be paid. The cash flow amount will be 380,000. Okay, then as per the question, the tax payments occur 1 year in arrears, right? So if you purchase or lease an asset at the beginning of the year, you will be able to deduct the rentals in the year 1, and taxable income will decrease in year 1, but the tax saving or the tax payment will occur in year 2. So the first tax payment will be saved in year 2, and then 3, 4, and 5. So till 5 years, the tax payments will the tax savings will occur. From the year 2 till 5. So tax savings. So tax saving will be 30%, which is the tax rate, which makes 104,000, 14,000. Now the present value fractions. For present value fractions, we can use an annuity as the cash flows are equal every year. So we'll be using an annuity, and it is the annuity fraction will be 3.673 for the lease rentals. I will tell you how I got this 3.673, and for the tax savings, the annuity fraction will be 3.269. Now let me tell you how did I get. Let me first calculate the present value. 380,000 multiplied by the present fraction. Present value fraction gives you 1395740, and the tax saving 114,000 into 3.269 gives you 372,666. So the sum of these two gives you 102,307. So this is the cash flow that would occur if you acquire this technology using a lease. Okay, now let me tell you about the how did I get the annuity fraction. Okay, so annuity fraction, when n is from 0 till 3, 0 till 3 years. So first I would take annuity fraction when n equals to 0. N means a year. It's the payment is at year 0. So obviously the payment which occurs at year 0 will be having a full present value. So we will assign 1 to the present value fraction. Then when n equals to 1 to 3 years, the remaining 3 payments. So pick the annuity fraction from the annuity table, or use the formula 1 minus 1 plus r to the power n power minus n divided by r. Now what will be the rate which will be used? So according to the question, they have given a rate 8.6%. Let me highlight it from the question. The rate is given over here 8.6%, but this rate is before tax. We always use after tax rate. We have to consider the tax shield as well. So the tax rate is 30%, and if you save 30% on interest, 30% tax on interest, so what will be the rate? So that discount rate, actually in case of lease and buy, you have to use the borrowing rate as a discount rate. You don't have to use the cost of equity. You have to use the cost of debt. So 8.6 is the rate. We'll multiply it by 1 minus tax rate. Tax rate is 0.3 in order to get an after tax rate. So 8.6 into 0.7, 70% will be the cost, which is around 6%, approximately 6%. So you are going to take the annuity fraction at 6%. Okay, so at 6%, the annuity fraction for year 3 is 2.673. So if you sum both of these, this will give you 3.673. So this is how I got 3.673. Then from 2 to 5, annuity fraction from year 2 to 5. In that case, first I'll pick annuity fraction for 5 years when n equals to 5. So for the 5 years time, the annuity fraction is 4.212 at 6%. And I don't want the first year's present value because the tax saving will not occur in the year 1. So what I will do, I will deduct the annuity fraction for the first year, n equals to 1. I need to begin the annuity from year 2. So I will deduct from here, n equals to 1. And that's 0.943. So this gives you 3.269, which I have taken above. So this is how I get the annuity fractions. So this can also be tested in an MCQ, please, the annuity fractions. So please be careful regarding these. Okay, now this is the cash flow from leasing part. This was a working which you're watching in the yellow patch. Right, now let's move on to the next working, which involves calculating present value of cash flows when the business borrows funds and owns the asset. So the business acquires the ownership. What happens in that case? So in that case, let's make a cash flow first. Okay, first cash flow is the capital expenditure, which will occur immediately. It's 1 million. So an outflow of 1 million will occur immediately if you buy the asset after borrowing. Okay, the next is after capital expenditure. What happens that in 4 years time you will be able to receive the residual value because you own the asset. You can sell the asset after 4 years and you will be receiving a residual value of 100,000. So after that you will be paying a license fee, and the license fee is 104,000 as per question in year 1, and it will keep on increasing by 4% every year. So multiply 104,000 by 1.04. So if you multiply 104,000 by 1.04, you'll get 108,160. So these will be the cash outflows occurring. If you own the asset, you have to pay the licensing fee yourself, right? So that's why I'm using it over here. You are going to use differential cash flows. Differential means only those cash flows which are different in leasing and in over here buying the asset, right? So only those cash flows will be covered which are different in both situations, right? So over there was no licensing payment, but the licensing payment will occur in this case of owning the asset. Okay, so there it's an incremental or differential cash flow that's why I'm using it. Okay, so over here now in the next year 108,160 into 4%, and then the year thereafter will be 116,986. Okay, after this tax benefits would occur. So what will be the tax benefits? So tax benefits are going to be different as well. Now what happens if you own the asset? The company will be deducting tax depreciation or tax allowances, capital allowances from the taxable income. Plus this license fee is also a business expense. So the business will be able to claim this license fee as well from their taxable income. So both will be deducted from the taxable income and the tax depreciation and the license fee. And the business will be able to save some taxes. So how much taxes will be saved? I made working in advance. So I'll be showing that working to you for the tax depreciation. And that working is being shown over here. So if you watch, on the screen, you will find that 1 million was the asset and the first tax depreciation was 25%, which was 250,000. This will be deducted from the first year's taxable income, right? And on this 250,000, you will be able to save how much? 30% tax. So which makes 75,000. Likewise, 30% of the tax depreciation. In the last year, when the book value becomes 421,875, you just receive a residual value of 100,000. So the company incurs a loss of 321,875. On this, you get a 30% tax relief. Loss will be deducted from the taxable income. It is deductible, and you save money. Okay, and then these are the benefits on the license fee. 104,000 multiplied by 30 30%, and in the second year's license fee into 30% likewise. So these are the benefits. If you sum up all these benefits, both of them, on the tax depreciation and on the license fee, you save this much in the last column, right? So this column, the total one, will be taken as receipts because this is a saving on tax due to this. And obviously this is different from the leasing arrangements tax saving, right? So you will be taking a differential cash flow over here. So let's move on to our main working. So tax benefits will begin from year 2, 106,200, because in the first year we'll be saving tax, and then uh, the taxable income will be reduced in the year 1, but we'll start saving in the payment will occur in year 2. So we have to take the time when the cash flow occurs. So 88,698 in the second year, then 75,934 in the third year, and then 131,659 in the fourth year. So in the fourth year means consecutively starting from the second year, second, third, fourth, and fifth year. So these are the tax benefits. Now we arrive at the net cash flows from the ownership of the asset. These are the NCF, the net cash flows. The net cash flows for the 5 years are as follows. So once you get the net cash flows, we now have to calculate the present value. So we'll put in the present value fractions. Remember, we have to take the same rate, which is 6%. When you are discounting the cash flows for leasing and borrowing, in both cases the rate should be same. The borrowing rate will be used, not the cost of equity. So let's take the present value fractions at 6%. Okay. And now we calculate the present value at 6%. So the present values at 6% will be the cash flow, net cash flow multiplied by present value fraction. This gives you the net present value. Add all these present values. This will give you the net present value of cash flows due to borrowing. So this makes 974,762. Now compare both of these. So if you compare the leasing cash flow and the borrowing cash flow, net present value of cash flows due to leasing. The leasing cash flow is higher than the borrowing cash flow. So what happens? This is a negative cash flow. So as the present value of borrowing cash flows are lower it is financially viable to borrow rather than lease the asset. So that's the conclusion to our lease or buy decision, that we will borrow. Borrowing is cheaper. Okay, so students, now the next part. Let's move on to the next part. Next part of the question is that using a nominal approach, calculate the net present value of buying the new technology and advise whether ASOP company should undertake the proposed investment. So now what happens, that due to investing in this new technology, the company will be able to save 5.8 of its cost per unit. So 5.8 is the cost per unit which they can save by buying this technology. So before we go on to the lease or buy cash flow, what should we have first checked? We should have checked that whether the NPV of the equipment or the technology that will be purchased is positive or not. So first of all, we should have checked that. So let's first check that whether the project's NPV is positive or not. So let's make a working to see whether the project of obtaining this technology gives a positive NPV or not. So let me show you in the question what's the saving expected. So what's happening, that 5.8 per unit in current price terms is the reduction in the operating cost due to buying this technology, and the inflation rate expected is 5%. So we have to inflate the cash flows, right, by 5%, and the cost of capital used to discount this is 11%. So let's calculate the present value of the savings in order to know whether the NPV of the project is positive or not. So let me do a working first on this. Okay, so I'll be making a working over here, which you'll be able to see in an orange patch. So it's a 4-year project. Okay, the first thing we have to do is we have to calculate operating cost per unit that will be saved. So operating cost per unit is 5.8, which will be saved. So in year one, we will take 5.8 multiplied by 1.05, because in the next year, the inflation rate is 5%. So the cost incurred will be 6.09 and not 5.8. And thereafter, it will keep rising by 5%. So keep increasing it by 5% every year. Keep multiplying the previous cash flow by the previous cost by 1.05% in order to arrive at the inflated or the nominal value. So in two places, this will be the savings. Okay, now this is the savings per unit. Now multiply the savings with the production quantity. So the production quantities for the year are 60,000 in the year 1, 75,000 in year 2, 95,000 in year 3, and 80,000 in year 4. Now this results in cost savings per annum 60,000 into 6.09. Okay. So there you get the savings. So these will be the savings per annum. Okay. So now rest of the workings, I have already done the working. So I'm picking that working up from now on. So you will be seeing the remaining working on the screen now. In a few minutes, you'll be seeing the working. Okay, there you go. So now I have already made this working. So you can see I have picked the figures from here. Now 365, 400 have been taken over here. And due to rounding off, there is a bit difference over here in the working. Okay, so I've exactly rounded off to 2 places so that these figures now match with this working, right? So you get these savings. Now on these savings, the company will be able to save tax at 30%. So 30% of tax is calculated, and it has been taken in the next year because the tax payments would occur in the next year. So they have to pay taxes on these savings. So as the cost will reduce, the taxable income will increase, and they will have to pay more taxes. So you can see the tax payments over there due to the savings. Okay, so now 11% was the present value fraction. After calculating the tax savings, after calculating the cost savings and taxes to be paid on those cost savings, we get the net cash flows, and then we calculate the present values of those net cash flows. So once we calculate the present values, what do we note? That the present value of the benefits is 1.135 million. This is the sum of these items. The present value of savings, cost savings. So the present value of the savings have been taken down over here, and then the present cost of financing, of borrowing, has been taken over here, right? So this gives you an NPV of 1,60,975. So as this is positive, the project is acceptable. Right? So according to this working, the project gets acceptable. The investment in new technology is acceptable on financial grounds, right? So that's the decision to this. And now let's move on to the next working, next part. Okay, students. So moving on to the next part, the last part of this question is discuss and illustrate how ASOP can use equivalent annual cost or equivalent annual benefits to choose between the new technologies with different expected life. So this is a replacement decision. So we did the replacement decision yesterday as well, but in that we use equivalent annual cost, right? Over here I'm using equivalent annual benefits, EAB. So equivalent annual benefits. You can also use equivalent annual benefits. So over here we will calculate equal annual benefits if the machine's life is 4 years, right? So in the market, what's the replacement decision? Replacement decision means in how much time should the business replace the asset. It should buy the new one. So obviously the assets lives are sometimes 10 years, 15 years, 20 years, but we keep them replacing in shorter time intervals, in 4 years, 5 years, 6 years. So we have to check that what time is most suitable. So over here we are replacing in 4 years, but other working should also be done, like other machineries or other options available should also be checked, like 5 years, 3-year option, and net equivalent cost or net equivalent benefits of those options should also be checked. Now in case of net equivalent benefits, net annual benefits, we have to see that from what replacement cycle or from what time interval we generate more equivalent annual benefits. And in case of EAC, we check, because it is about cost, we take the we accept the replacement cycle with the lowest EAC, equivalent annual cost. So let's we have already done EAC, so let's do an EAB calculation, equivalent annual benefit calculation in this case. So the equivalent annual benefit calculation in this case can be done. We have already calculated the present value of the machine, right? So what was the formula? The step one was calculating the present value, and the step two was dividing the present value by the annuity fraction. So we'll divide the NPV with the annuity fraction over here. So in here, let's calculate the EAB. So the formula is same for economic equivalent annual benefit. The formula is present value of cash flows divided by the annuity fraction. Now in this case, we'll be using the annuity fraction for 4 years because the project is for 4 years. And then we'll compare the EABs for 3-year life assets, for 5-year replacement cycle options. So whichever is higher, we will select that one. So in this case, our work will be, the NPV is 1,60,795. Divide this by the annuity fraction, which is 3.102 at 11%. This gives you the equivalent annual benefit. Equivalent annual benefit means if in actual, in reality, the cash flow every year is different. But suppose we want to see that what will be the cash inflow or benefit every year if it is same. So the same cash flow will be like this: the annuity 160795 divided by 3.102. So this is 51,835. Now, in order to select the best replacement cycle, this equivalent annual benefit will be compared with alternative options involving less than or more than 4-year life cycles. If the EAB using a 4-year life cycle is highest, then ASOP shall replace its technology in 4 years time. So this will be the discussion on this last part. So as per the question, they were asking for the discussion and the calculation as well. So I've done both over here, right? Okay, students, let's move on to the next question now. So moving on to the next question. Before moving on to the next question, let me take some questions first. Okay, Bilal asked a question that why haven't we considered the cost of license fee in the calculation of NPV? So I haven't considered the license fee in NPV due to the reason that I have already considered it in calculating the financing cash flows. And as you saw, I deducted the cash flows from borrowing from the saving cash flow, right? So it has been considered over there. That's why I have not considered it, because it has already been considered uh, in the borrowing cash flow, right? So clear, Bilal? Okay, then there's a question from Subhan Ahmed that can present value of cost of finance be calculated by using 11% WACC? It can be used, but as this is a financing arrangement, and usually these are at the borrowing rates, these are being done at the borrowing rates in the market, it's always better to use 6%, but you can use 11% as well. Okay, but it's better to use 6%, right? The cost of financing, if it's available. If it's not, then you can use the WACC. Okay, one more option. Can we calculate EAB for each individual year? No, it's not for individual year. It is for complete replacement cycles. Replacement cycle means, suppose you have 3 options that to change the technology in 3 years or 4 years or 5 years. So you will be calculating the present value first for 3 years, then for 4 years, and then for 5 years. And then you will dividing by annuity fraction for 3 years, 4 years, and 5 years. So you will getting an EAB, in which in either of the case you get the, in any case, in any one of the case, you will get the highest NPV. So that will be selectable for you. Okay, Rohit. So next, yes, there is a question from Rafe that will I be uploading the answer script? It's yes, I will be uploading the answer script. Uh, okay, then okay, can you repeat the tax shield calculation and leasing part? Okay, Advait, the tax calculation was like this, that if you are paying 8.6% interest, right? So interest is usually deductible from the taxable income. So if you deduct it from the taxable income, your taxable income will decrease. And due to that, you will be saving a 30% tax, right? So due to, if you pay 100 rupees interest, so you will save 30 rupees on tax saving. So how much will be the interest cost to you? It will be 70, right? Which is 70%. So likewise, what I've done, that I have taken 70% of 8.6. Okay, so that's I hope you have understood, Advait. Okay, okay, Dureshava, see, as they have already asked you that first you have to compare the financing cash flows. So you have to deduct the tax depreciation from there only, right? But if they have not asked you about the financing cash flow, then you can do it from here. If you only have to calculate the net present view, is it okay? Okay. Then how can it be lower? What the equivalent annual benefit you are asking about? Equivalent annual benefit? Yes, it can be lower or higher due to the fact that the residual values usually change and the maintenance cost change. If you have older assets, you may have lesser residual values and more maintenance cost. So that may change your EABs, right? Okay. Okay. Part C was like that, Sidra, that in how many years should we change the technology? Like if you have a car, so some people change their cars in 5 years, some people change in 4 years, some in 3 years, some in 2 years. So they have different replacement cycles. So in order to know that, what we do, we calculate an EAB or EAC, right? So I hope, yes, is it okay, Sidra? Okay, so the questions are over. Let's move on to the next question now. So I have done some workings for the next question, but I'm doing some the unique workings for, which we do for the first time. I'm doing those working on the Excel sheet, and the remaining the repeated ones I'll be showing you them some ready-made workings which you'll be finding on the uh, Excel sheet on the WhatsApp group after we complete today's class, right? So Herrickson is the next question. Please go through this question. So I'm giving you a 3-minute time to read the question. Please go through it. Students, until you are reading this question, I am making some short workings on the sheet so that we can save some time. So I'm working on it. You can please continue with reading the question. Okay, students. Over here, let me tell you about the selling prices in this question. So what the question says that the selling prices are dependent on future economic conditions which are uncertain. So according to the question, there can be three economic conditions: weak, medium, or strong. And in all of these conditions, the prices are different. The price will be 25 in weak condition, 30 in medium, and 35 in strong conditions. So which price you are going to use? So over here, if this project is going to occur again and again on repeated basis, right? So what happens? Sometimes the price will be 25, sometime it will be 30, sometime it will be 35. So you can use expected values or the weighted average. So what we'll do, we'll multiply these by their probabilities and calculated a weighted average or the expected price. So first of all, what we'll do, that we will calculate an expected price. Expected price or expected value is a weighted average, right? So what will be the weighted average price? 25 into 0.35. So first we'll multiply the prices with the probability, and then you will sum all of them. You will get the expected price. So expected price is 29. Now this expected price 29 is in the present day prices, and they are expecting an inflation as well in this question. So they are expecting an inflation of 4% on this price. So what happens, that even if we take this price 29, which is today's price, this price is going to rise by 4%. So increase it by 4%, 29 into 1.04. So 29 into 1.04, you get 30.16. Then in the second year, you get 31.37. In the third year, you get 32.62. And in the fourth year, you get 33.93. So we have used an expected value to calculate the sales in this question, right? But suppose that this project is going to occur only once, then we cannot use this expected value. Then we have to calculate three different NPVs. One calculation for NPV we will have to make when the price is 25. The another one we'll have to make at 30, and the third one at 35, and then analyze all three of them separately, that what price is mostly going to occur and what are the risks being faced in all the three situations. We won't be able to take an average if it is not, the project is not of a recurring nature, and it will not keep on occurring again and again. The averages can only be used when the projects are being or the options are being occurring again and again on repeated basis. Only then you will be able to take the effect of the average. And when the average is high, the total is also high. The average is low, the total will also be low. Okay, so sales revenue over here now will be on the basis of average price. So I'm taking the sales revenue in thousands for the remaining workings. So these will be the sales amounts. So the rest of the working I'll be showing you, which I've already made. Let's move on to that working. They've already given you the variable cost in the question. So we won't have to calculate variable cost, but we have to calculate the factory overheads, which are also rising. We have to inflate the factory overheads as well. So let me show you the NPV working for this question. First of all, you will be seeing the working for the factory overheads and the tax depreciation. So there you go. That's the working for the factory overheads and the tax depreciation. So inflation is 4%. So we have increased the factory overheads as well, which are 400 for the current year. I have increased it by 4%. And then the tax depreciation is going to be 4.5 million. There's a residual value of 500,000. And the tax depreciation on straight line basis. So 4.5 million divided by 4 will give you 11,25,000 tax depreciation. And deducting this 11,25,000 from the taxable income will make you save 30%, which makes 337,500 per annum. So this will be the tax saving per annum, right? And the factory overheads inflated at 4% are this much. So these figures will be used in the question. Variable costs are already given in the question. These are the variable costs: 2385, 4200, 7080, and 5730. Now let me show you the full working of NPV. So there we go. We get the full working for net present value. So I have taken sales from the above values, variable cost from the question, overheads after inflation. So this is the sales from our working. Then variable cost from the question, overheads from our working. You get the cash flow before tax, and the tax is now payable in the same year. So as it is payable in the same year, it is occurring in the same years. Sometimes we pay advance taxes, and then tax benefits also in the same year, both in the same year. If the tax payment is the same year, then we will take the tax depreciation benefit also in the same year. There you get this cash flow, and the scrap value is 500 taken as a receipt, and the project cash flow, and then the present value at 11%. So there you go. You get the NPV of the project, which is 3809. And please go to the decision which is written down, that if the project keeps occurring on repeated basis, then we can use the expected values. Otherwise we can't use expected values. We have to calculate NPVs 3 times using the different selling prices, and then we have to consider their risk and consequences separately. So please go through this gray shaded portion of the decision at least. So I'm giving you a minute to read it, and then we'll move on to our next topic, and which is cost of capital. So our next topic will be cost of capital, starting within a few minutes, 2 to 5 minutes. Okay, students, let's move on to the cost of capital work now. So students, this handout number 2, day 2 work includes financing decisions and the cost of capital. What I have done, I have selected more questions for the first 4 days, and for the 5th day I have taken some less questions in the handout, so that if we leave some questions for day 1, 2, 3, 4, we can complete it by the 5th day. Okay, so students, let's start with this question. Calvin Company, the question 1. Please go through it. Go to the question. And I'll starting giving you the answers in a short while. Okay, the first question is about the theoretical X-right price. Question A. Theoretical X-right price per share in dollars. What is the theoretical X-right price? X-right means afterwards, and theoretical X-right price means after the right issue. Theoretical means that according to the book, according to the rule, it may not the X-right price may not be the same as this we have calculated, but it should be like this. It should be the same as this much according to the concepts. But market values are usually they may differ. So the theoretical X-right price is required over here. Let's calculate it. What the question says, that there are currently 4 million shares outstanding, and the market price of each share is 20. So this should be the market value of the capital. So currently the market value of the capital is 80 million, right? 4 million shares into 20, and the company is now planning to issue 1 share for every 4 share. So one for every 4 share will be issued at a discount of 10%, at 90% price, means at $18. So 1 million more shares will be issued at 18. So this means the total capital will become 98 million. 80 is the market value existing shares, and further shares that will be issued will be 4 million plus 1. So that will make the number of shares 5 million, and the further 1 million shares will attract 18 per share, as the right price has been 90% of the market price, which is 18. So After the right issue, the capital will become 98, 80 plus 18, and number of shares will become 5. So this gives you the theoretical exercise price, 98 divided by 5. So it's 19.6, which is the answer to this first part. Now some conceptual questions regarding the theoretical exercise price. Let's take those questions. Okay, students. So moving on to part B. So according to the part B, the question says, what would be the effect on the theoretical X right price value if the new share were offered at a 20% discount level? So if it is offered at a 20% discount, what happens? This amount will go down. This will decline, right? And obviously this amount will also decline, right? So if these two decline in the numerator, obviously the price, the theoretical value will also decline. So what's the correct answer? It's C. The theoretical extra price would fall. The correct answer is C. Okay. Moving on to the next one. Okay, please let's read this question. What do it say that indicate by clicking in the relevant boxes whether the following statements about discounts on a right issue are true or false. Now, what's the first one? The level of discounts is simply not relevant to the wealth of a shareholder as long as they accept the right. See, if a shareholder accepts his right share, right, his wealth won't be affected. His wealth will remain same. Why? The reason is that, as you saw, that the market value in part A was 20. Once the right shares are issued, the market value declined to 19.6. So what happens? If a person was holding 4 shares at $4, at $20, so now his share price declines. So his value of 4 shares goes down. But if he buys the 5th share, he will be just paying $18 for it, but he'll be getting a share of 19.6. So the value lost in his existing holding has been gained through buying in the $18 right share, where he gains a share by just paying 18 and receiving a share of 19.6, where he gains 1.6, which he lost by which he lost due to the issue of right share. So if he do not accept the right issue, he will be losing 1.6 in his wealth. So this one is perfectly right, that his wealth will only be affected when he do not accept it. If he accepts the right, nothing affects his wealth. So it's better always to take the right issue, accept the right issue, to keep the wealth of yours at the same level. Otherwise, due to right issue, the wealth will not increase. If you accept it, it will remain at the same level. But if you do not accept it, you will be the loser. You will lose some value. Okay, next. The bigger the discount, the more likely a shareholder is to accept the right offer in most cases. So that's also correct. The more the discount, as said in part B, the theoretical extra price will fall, but he can buy more shares. So that's also correct. By paying less amount, he can buy more shares. So if prices are low, demand will be high. So that's correct. So both of these are true. Now this was a simple question. Okay. Moving on to the next part, part D. Students, I'm right now not going to the chat. I will, when I will complete this question, the 5 parts, then I'll go to the chat box and see the questions. So please wait until I'm able to see this chat box. Okay, let's move on to the next part D. Now the question says, which of the following actions by shareholders would be the worst thing that they could do in relation to a right issue as far as shareholders' wealth is concerned? So what will be the worst in here? The worst is do nothing. Do nothing means not to purchase any right shares. If he do not purchase any right shares, he will be a loser as explained earlier. So C is the correct answer. Now, if he accepts the right offer, that's the best. This is the best one. Then if he renounces it, if he says that I don't want the right shares, please sell it and give me the cash and give me the gain out of it. So that's also okay. The amount which he loses in the value due to the decline in the theoretical extra price, right? So he will gain from the gain by selling the shares in the market. He will be selling the $18 share in 19.6. So he will gain 1.6 from there by selling it. And if he sells 50%, even then he saves some value, right? But in this case, in C, this is not recommended. He will be losing the most. So what they are asking that what will be the worst? So worst will be that he does nothing. At least he should buy some shares, right shares, so that he can obtain compensation of the decline in the market value after the right issue that occurs. The correct answer is C. Okay, students, let's move on to the part E now. So moving on to the part E, the question says that which of the following actions will result in least dilution? Now, what do we mean by dilution of control? Dilution of control means the voting rights. Control on the company and the policies of the company, decisions in the company depends on the voting rights. So once you become a shareholder, you get some voting rights. The more votes you can cast, the more will be your control. So where can control be diluted? By issue of new shares, right? In what happens in case of right issue, that if you have 20% of the voting rights and a right issue is undertaken, so you will get 20% further shares of the new shares which are being issued as right issue, as right shares. So obviously, if you get 20% new shares and earlier also you had 20% shares, so your percentage holding will not change. So you do not lose any control which you had earlier. So by due to the right issue, if you take all of the right issue by right shares, except all of the right shares, you won't be losing any control over the company's decisions and the policies. So the correct answer to this is that accept the right offers without any negotiation. This will otherwise, in all cases, if the investor either do not accept any share like here, so he will be left away with lesser number of shares because the total number of shares will increase and he won't be gaining any share if he rejects the right issue. So his percentage will reduce from 20% to some reduced percentage, and he will not be having the same amounts of votes which he used to have earlier. Okay, so the best answer is uh, A is the best answer to this. The correct answer is A. Okay, let's move on to the question number 2 now. Dominance company. So students, please read the question. So I'll be silent for 2 to 3 minutes time until you read the case, and then we'll start answering from requirement A. I want to give some tips also here regarding doing the MCQs. Is that students always read the question very carefully. So your answer is dependent on how well you read the question. So people who do not read the question properly, and they are too much, uh, you could say, in hurries. So basically doing things fast and not reading the question properly may make you uh, take or select or give an incorrect answer. So it's very recommended that first try to understand what uh, the examiner is wanting to ask you first. So never mind if it takes 1 more minute to understand it, but please do not hurry so that you lose a mark very carelessly. So it's very important that you read the question properly and uh, just think about various aspects before you select an answer. And secondly, an important tip is, if you are not understanding anything out of the question, you're not getting uh, at all, you're not getting anything, that you're not understanding the question at any percent, you're 0% understanding the question, right? So in that case, immediately move to the next question, because if you do not know the topic, right, so it won't be fruitful to think more on it. But remember, there are no negative markings, there is no negative marking in the exam. So if you move ahead, right, do not forget to take or guess any one answer from there, because suppose it gets right, obviously you don't know it, you don't know about it, and you're not being able to decide on your conceptual basis, but your guess can get right. So try to at least mark one of the answers from there, right? But if there is a box, then it will be difficult, right, to what to put in that box, right, without any calculation. So at least for MCQs or objective type question, true false, at least do some guesswork. So if it gets correct, so you may get a very good mark. And remember, sometimes 1 mark is equal to 100 mark, which is the difference between 49 and 50. So if a student gets 49, so he loses the whole exam. But if he gets 50 by attempting only uh, uh, maybe a fortunate question from the exam where he gets his guess correct, so he gets 50, so it makes 100% to him, because he gets passed due to that single mark. So please, it is suggested that do not uh, leave any questions where you have chances to select options or to mark true and false, right? So please, first of the tip was read the questions carefully and then answer, don't hurry. And the second tip is that please do not miss any question, at least select or guess, use your guesswork if you do not know anything out of it. But don't waste time, excessive time, in doing unnecessary reading into a question if you're not getting it, because uh, if you uh, do not uh, if you attempt the question which you do not know and put in some unnecessary time, what happens that you may miss some questions afterwards which you did know, from which you could have attempted and get some marks. So at least try to obtain marks from that portion first, which you know well. So in the end, there should not be any portions in the exam which you leave, and you knew those portions. So if you leave some portions from which you could have obtained marks and you miss those marks, that would be very unfortunate, because knowing some areas, you won't be able to gain marks in the exam from there. So it's always better to not to spend much time on areas where you cannot get marks. So invest more time in the areas where you get marks. So there is a same concept of limiting factor applies here. In which projects do you invest first? If you have capital rationing situation, where do you invest first? You invest in those projects where the NPV per dollar is highest. Likewise, in the exam, you have rationing situation. You don't have capital rationing, but time rationing situation. So you have to utilize your time in the best way. You have to put in more time in areas, in questions where you can get more marks per minute. So the areas where you can get more marks per unit, you should invest more time over there. And then in the end, when you save some time, then you can come back to that portion of the exam which you felt that you don't know, and do some and get some marks over there by putting in your guesses, right? But that area will be attempted in the end of the exam when you have done all questions with marks per minute. So in the end, you will be doing the questions with the ranks which are very ahead, right? So make your priorities first. Do the priorities. Select your choices should be correct. Okay. So let's move on to this question. This was a short break in which I discussed that limiting factor situation as well with you in the exam situation. Okay, there is a question from Advait that okay, Advait says that why not D in question 1's part B. So remember, Advait, that if the theoretical exercise price fall down, it doesn't matter to the existing shareholders, because they are not losing any sort of wealth. In one side, the existing shares value will decline, but on the other side they gain by buying shares cheaper. So as said earlier, they won't be losing any wealth whatever be the price. Even if the price goes down, that sometimes it is very good that the share prices goes down, because if it drops down too much, then the purchasing power of people increase, then the share prices, despite of declining, they may increase, and they give some wealth to the shareholders as well. Okay, so that's what the answer to this. And then, okay, very sorry for Duresh Ewa. Okay, Sheikh Imran, you must be having a control panel on your screen, this webinar screen. So you will find questions over there, or chat over there, chat option. So please open that chat option So you'll be able to ask questions over there. Okay, so there is one more question from Collie. Collie is asking that where did I get 18? So 18 is basically 90% of 20. $20 was the price and 10% discount is being offered. Yes. Okay. So you can get from we reduce the $20 market value by 10%. Okay, let me take a few more questions and then we move on to the question number 2. Okay, Aisha's question, Aisha Musani, that why are you using expected selling price even though it is mentioned that it is not recurring? Actually, the question is asking to calculate expected NPV. The requirement is to calculate expected NPV. So if the question is asking for the expected NPV, means we have to use the average price over there. Only one NPV in the situation. We won't be calculating 3 NPVs. And Dureshwar asking, will be covering questions on hedging? Yes, we'll be covering the questions on hedging on the day 5. Working on overheads was 400 was the overhead price in today's prices. And then you have to multiply 400 by 1.04 and keep on multiplying by 1.04. You will get other overheads as well. Is it okay? Ibrahim, sorry, this was Sheikh Imran. Okay, some more questions in there, but whenever the topic related to that question will come, I'll be answering at that time, right? So sometimes you put on question which is not related to the topic being going right at that time, so it's difficult to answer because other people will get confused, no? So I will answer about some of your questions, Kamran, and 1 or 2 more people asking the same questions. I will be answering to them when I will be discussing the dividend area, right? Yeah, Aisha, cost of capital can be different in lease or buy decisions case. But if you are being given the cost of capital WACC and the borrowing cost in case of evaluating whether to borrow or lease, you will be using the borrowing rate. And in case of calculating the NPV of the whole project or the savings, then you'll be using the cost of capital or the WACC. Okay, students, let's move on to question 2, dominance company. So the first part, the requirement A of the dominance company is, assuming the business wants to retain control in the hands of existing shareholders, how should it seek to raise the new finance? So they want to keep control with themselves. So the correct answer to this is issue new debt. Issue new debt by issuing loan notes and raising money. They can raise funds without giving any voting rights because voting rights are connected to shares. Okay. So moving on to the next part. Assuming the business wants to maximize the tax shield on the new finance, how should it raise the money? So remember that if the business wants to maximize the tax shield, so how can you maximize the tax shield? By obtaining loans through borrowing rather than raising funds through equity options. Because if you raise funds from equity options, uh, dividends which are being paid on share capital or equity shares are not deductible from taxable income. As dividend is not an expense, you cannot deduct it from taxable income, but you can deduct interest from the taxable income. And by deducting the interest expense from the taxable income, you can save some interest. So you can save some taxes on that interest. So what happens that your cost, your the suppose you have a 10% cost on equity and 10% cost on debt. So if there's a 30% tax, so the cost of equity will remain 10%, but the cost of borrowing will get 7%. Why? Because you get a 30% saving in the taxable income due to the payment of interest on borrowings. So the cost of debt is lower due to the tax savings. So it becomes 7%. So if you have an option to borrow, so it's better to borrow rather than obtain equity so that you can take advantage of tax shield. Tax shield means that due to borrowing you pay interest, and that interest helps you saving in some tax. So you save yourself from tax due to interest, so it becomes a tax shield. So from in this case, uh, I'll just tell you the answer first, that what's the correct answer for the part B. Let me first write the answer for part A. The answer for part A was D. And the answer for part B is again the answer is D. Why it is D? It is D. Now remember one more thing. Your total cost of raising funds, right, will decline if you borrow more and more, right? Am I right? If you borrow more and more, borrowing is cheaper. So if you add more funds from borrowing, so your cost of cost of finance will reduce because interest is cheaper due to tax shield. But if suppose you get an option to borrow at 6%, an option to borrow at 4%, what should you borrow? The 6% borrowing or 4% borrowing? 4%. Why? Because the 4% borrowing will give you a lower cost, and out of that 4% you will save 30% tax as well. So it becomes 2.8 cost only to you. So it's better to first of all find a, a cheaper option, means save some taxes by borrowing rather than going for equity. And then once you find the option of borrowing as a cheaper option, then out of the borrowing options you should find an option of borrowing which is cheaper amongst borrowings. So the cheapest over here is the option D. So this is the best option. Okay, next, the requirement C. What is the percentage cost of equity to one decimal place? So you have to calculate the cost of equity. Now the working start. So in this question, let's talk on the cost of equity now. How will we calculate the cost of equity? There are two ways in which we calculate cost of equity. One is the CAPM, the capital asset pricing model, and the second one is the dividend growth model. So okay, students, let me clarify the my answer on part B. There are some questions on it. See, the highest tax shield will be on 5.25% interest, right? Suppose we are getting a 30% tax saving. So over here, we will get the highest tax saving, 30%. On 5%, we'll be only able to get a lesser tax saving, 30%. For example, if there is a 30% tax. So in option D, we are getting the highest tax saving, right? So they are talking about tax shield only in this question. They are not talking about the WACC, the weighted average cost of capital, right? So in case of weighted average cost of capital, we would have selected the option C because it is having a lower cost. But in case of maximizing the tax shield, we will select the option with the highest interest rate so that we can save the highest tax. More interest means more tax saving, right? So that's why I'm taking option D. So that's for the clarification to the questions. Okay, next, moving on to the part C now. Okay, so students, in this question, what happens that they have told you about that the company's share price, existing share price, come dividend. Come dividend means that including dividends. Now what happens that when the dividend is to be declared in a short time interval, the prices of shares increase because people know that the company is going to pay dividends, so the share prices goes up, right? So come dividend price includes dividend as well. Come means including, X means X dividend means after paying off dividend. So once the dividend is paid, then the expectation of people that the dividend will be paid goes over, so goes out. So ultimately the prices goes down, right? So existing equity is quoted at 4.2, right? And what they say that the imminent dividend means the immediate dividend which will be paid right now, right? So this is what you were asking, right, Kamran? Imminent dividend. So imminent dividend means the immediate dividend being paid. Yani, the closest dividend which is going to be paid is 16 cents, right? So as this was required in part C, I was making you wait. Sorry, Kamran. And a few more people were also asking about imminent dividend. So now it's part C in which this is to be used. That's why I'm discussing here. Okay, Sabah, I have answered your question as well. And Adil, did you ask about part A? So in part A, see what happens that in all of the above options, the company is issuing some shares. So due to issue of shares, what happens that some shares are being issued to new people other than the existing shareholders. So if the shares go to new people, some percentage of voting rights goes to the new people. But by issuing loans, loans do not carry any voting rights. So if you issue a loan note and raise funds, what happens? No voting rights given to anyone. All voting rights remain to the existing shareholders. So that's how. Okay. No, it's not selling debt. Selling debt means we are selling loan notes in order to raise funds. It's issuing loan notes. Okay, Adil, that's good. Okay, is it okay? Okay, so let me now start with the cost of equity. So what happens that the dividends are currently increasing at 8%, and it is expected that now in the future they will increase by 2%, right? So in total, now the dividend growth rate is expected to be 10% in the future, right? So the very recent dividend, the imminent dividend is 16 cents, and it is expected that this dividend will increase in the future by 10%. So the dividend growth model will help you in calculating the cost of equity using these items, which you are watching over here. And you will need the formula for the dividend growth model, which I am writing down on the Excel sheet near to the part C. So the formula for the dividend growth model for cost of equity, KE stands for cost of equity, right? Is D. D stands for the current dividend, D, O or D, 1 plus growth rate divided by the X dividend price of the share. And to this fraction we will add, now please remember this formula, the growth rate, which is 10%. We will be using the future growth rate, and it has been predicted from the previous year's trends, right? So according to this, if you put figures in this formula, the cost of equity will become, the dividends are 16 cents multiplied by 1.1, 1 plus the growth rate 10%, right? Divided by the X dividend price. So you are being given the cum dividend price, which is 420 cents. So what you have to do, make it an X dividend price. 420 minus the 16 cents. 420 is the cum dividend price. We need X dividend price. So I've deducted the dividend from there, so that we get the dividend uh, X dividend price. And after payment of the dividend, the price will come down to 404 cents. Okay, now the next is 10% growth rate. So this gives you the cost of equity, which is equal to, multiply this by 100, you will get 14.4%. So 14.4% is the answer to this question using the dividend growth model. Now, why did I use the dividend growth model? I do have just two options to calculate the cost of equity. One is the dividend growth model, and the other one is cost of capital asset pricing model. Now the if they are giving you hints in the question regarding dividends and the growth rate, means you have to use the dividend growth model. And if they are telling you about the beta and the risk free rate and the market rate of return, then you should have used the CAPM. And if both are given, then use CAPM, because CAPM is the better model out of these two. So CAPM remains better model compared to the dividend growth model. So if data for both are given, always go for the capital asset pricing model. Okay, now let's move on to the next part, the part D. Okay. In an upcoming question, Aisha, we will discuss why CAPM is better. So I will answer it over there, right? And there is another question by Sridhar, that why didn't I select C in part B? The reason being the interest rate over there is low, so less tax saving over there. Okay, Reda, growth rate is 8%, and that's historic, right? So we won't take the historic growth rate. We will take the future growth rate. So according to them, they say that the growth rate has increased by 2 digits. So it has increased to 10% rather than 8%. That's why Rida, I have taken 10%. Is it okay? Okay, Shirti, I have not got your question. You can please ask a bit in detail. In more detail, what do you mean by why is it 10% in section C? So I didn't understood. Please, if you can elaborate, right? Okay, so moving back to the questions, the D, requirement D. So the requirement D is what is the after-tax cost of debt as a percentage to two decimal places. So let's calculate the cost of debt. So in this case, let me select the data required to calculate the cost of debt. Over here, what they tell is they have issued an irredeemable bond, and the interest rate is 4% over it. Irredeemable means that the bond will not be redeemed until the dissolution. It will remain outstanding forever, right, till perpetuity. And what they are telling, that there is a 25% corporation tax rate. Now as this is the loan, this will be the tax shield. 25% is the tax shield. We'll be saving tax at 25%, right? And then what is the market price? The market price of the bond is 80. So if a debt instrument which you issue in order to borrow, right, is irredeemable, whenever you issue a loan note or a debt instrument which is irredeemable, right, you will be using a formula for calculating a cost of debt. KD is cost of debt, right? So the formula will be cost of debt equals to I, which is the interest, 1 minus T. This is for irredeemable debts, right? Divided by the market value. Okay. In the yellow patch, you get the answer for cost of equity. And now in the green patch, you'll be getting the answer for cost of debt. So green patch shows you the answer for the cost of debt. Now, what is the interest rate? So the interest rate was 4%, right? So 1 minus tax rate, which is 25%, 0.25. So this 1 minus 0.25 leaves back 0.75. And then divided by the market value. So the market value of the bond was 80. 80 is the market value. So by dividing this, you get the rate, which is 3.75%. So answer to this part is 3.75%, the cost of debt. So you have to remember this formula now. Whenever there is a borrowing instrument which is irredeemable, you will use this formula: interest rate multiplied by 1 minus tax rate and divide by the market value. This gives the cost of debt. Now the last part of this question, part E. Let's attempt the last part, that cost of equity for dominance company significantly greater than the cost of debt. Okay, so cost of equity is very high compared to the cost of debt for the dominance, and usually the cost of equity will be higher than, always it will be higher than the cost of debt, right? Because the equity for investor is more risky. So the investors usually ask for more compensation in case of equity, and in case of debt, debts are less riskier for the investors, right, as they get a smooth interest over it, and they also get a security in case of default. So debts are less risky, so the rate of return on the debt being asked by the investors is usually lower compared to the cost of equity or the rate of return on the equity. So that's why for the company, equity is always expensive. Now what they say the main reason for this is, what can be the main reason, right? You have to select the main one. So out of this, the main reason is the part D, the systematic risk. Now what is the systematic risk? That needs to be elaborated over here. So now I'll be discussing the systematic risk, a bit about systematic risk. Now what happens that suppose you want to invest your money in some business and you want to buy shares. Okay, now if you buy shares, what happens, you buy shares in a food company, and there is another option to buy shares in suppose a motor car company, a car which is making luxurious motor cars. So where you will be taking more risk, in the food company or the motor car luxury company? Like in the pandemic, what happened? The food business was not that much affected compared to the luxurious car business, right? So it's a normal staple food business. So a normal staple food business, the demand of which won't much vary uh, dependent upon the circumstances, is a safer business to invest, as you can earn a reasonable profit, a smooth profit over the time. So what do we mean by risk? By risk we mean that the profits vary, that the profits change with change in circumstances. So in a luxurious car making company, the profits will very frequently change dependent upon the circumstances, so you cannot predict the profits in that business. So that business, the risk is known as an operational risk and unsystematic risk. This is known as unsystematic risk, which is based on industry. The food business will be having a lesser risk because the profits remain smooth. Now what happens that the investors don't invest all of their money in one business. They divide that money into various businesses. Why do they divide the money? So that they can invest in inversely related projects. Inversely related means one project which is in which there is a profit. In another project, they expect that at the same time, uh, when the first investment gives them profit, the second investment may give them a lower level of profit. So when the circumstances get reversed, the profits also get reversed amongst these two investment. Like when the second investment's profit increase, the first investment profit go down. So they can take advantage of both of the higher profits, and they they can earn an average profit by dividing their money into two or more investments. So this is known as diversification. Don't put all eggs in one basket. So by putting your investment in inverse related projects, you can diversify your risk. So what happens, every businessman is uh, prudent, and he will make a diversified portfolio. He will invest into various companies of different nature and different risks, so that his risk gets diversified and he's able to earn a smooth profits. So what happens now, that he gets rid of all of the industrial risk, all of the industry specific risks, like risk specific to the food industry, car industry, the spare part industry, the chemical industry, the pharmaceutical industry. These all risks have been diversified, they've gone. So what risk remains? The only risk that remains is the effect on profits of a company due to the macroeconomic conditions, like change in inflation, like change in the interest rates, change in the economic policies of the government. Only the effect of those remains, which a investor has to bear. So, and that's the systematic risk. Systematic risk means that the risk that is not diversified, that is not mitigated, and that risk is due to the change in the government's macroeconomic policy. So it is due to this systematic risk that the cost of equity is higher. Now if you invest money in loans, you won't be facing the cost of this systematic risk, because the interest is irrespective of the profits earned by the business. The company has to pay, the borrower has to pay interest even if they are in loss. If they are in profits, then also they have to pay the interest, and the interest remains smooth. So if the profits are smooth, there is no risk. If the return is smooth, there is no risk. So in cost of debt, you are not bearing that much of risk which is in equity. which is in case of investing in equity. And in equity, in case of equity, those companies which are more exposed to the macroeconomic policy will suffer from more fluctuation in profits. And ultimately, investors will ask for more returns from those companies which suffer from more fluctuations due to the macroeconomic risk. So it is due to the systematic risk that people ask for higher returns from a company which is having a higher systematic risk, the macroeconomic policy change risk. So that's the correct answer. D is the best one. Okay, so let's move on to the next part now. In all cases, this is a you can say that's a fact, that's a reality, that the cost of equity will always be higher. Okay, Terim asked for that, why 10% growth rate in part C? The growth rate historic was 8%, right? But they have told you that it is expected that the growth rate will increase by 2% in future. So that's why I've taken the cost 10% growth rate. We will always use a future growth rate, right? Yeah, the cost of debt is not dependent upon the cost of debt may change with change in circumstances. The cost of debt may also change with change in circumstances, means that if the conditions in the market regarding borrowing change, like interest rates change and the economic conditions change, the cost of debt may also change. But once one company has borrowed and it has committed according to the agreement, in that case the interest rate won't change. For a specific investor, like you suppose invest in a loan note, and you already enter into an agreement with the company and they say they will pay you 10%, then obviously you are going to get 10%, whatever be the case in the market, right? But compared to the market value, the percentage may change. But obviously you are going to get the same cash every year, irrespective of the change in market value, right? Okay, so this was the answer to Advait. Okay, so let's move on to the next question, AMH now. Please read this question so that we can proceed with this question now. Now this is purely now we are starting with the calculations on cost of equity and weighted average cost of capital now. So we'll be doing the detailed calculations of weighted average cost of capital, which we use for discounting the present the cash flows associated with projects. In the NPV calculation, we use these discount rate, which will be calculating in these questions like AMH. Okay, people are messaging to the number given on the control panel. So whenever I get free, I will accept your invitations. Right now, I'm not using the WhatsApp due to busy in this webinar. So I will do it afterwards, right? So please excuse me. Okay, so please go to this question, the later part of this question. Okay, students, the requirement is calculate the market value weighted average cost of capital, right? So in this question, in order to calculate cost of capital, let me give you a tip first, that what you need to find in the question first. Find the sources of finance. Find the sources from where the company gets funds in the question first. See, they are generating funds from preference shares. They are generating funds from 7% bonds. They are generating funds from long-term bank loans. And apart from these three items, 1, 2, and 3, they are generating funds from equity as well. The third source is equity, the equity shares, which you can see under the ordinary equity and under the head of equity ordinary shares. So there are 4 sources from which they are generating the funds. So we need to calculate uh, 4 things in this question. 1, we need to calculate the value of equity, the market value of equity shares, the market value of preference shares. We need to know this. They may have given you. We need to know the market value of 7% bonds. Bonds are basically loan notes, instruments through which we generate loans. And we need to know the market value of term bank loan. Usually term bank loans do not have market value. Their face value will be the market value only. Because they cannot be sold in the market, that's why they don't have market values. They are so first of all, we will find the market values of these items, of these 4 items of financing, right? And then we will calculate the cost. Now the next step will be calculating the cost of equity, then cost of preference shares, then cost of bonds. First market value of these 4 items and then cost of these 4 items. Cost of long-term bank loan, right? Now, starting with the first option, market value of equity. So for the market value of equity, what you need to know is the share capital. So the company has a capital of $4 million and each share is worth 50 cents, means 4,000 multiplied by 2. How many shares? 8 million shares. Each dollar is divided into 2 ordinary shares of 50 cents each. right? So in total there are 8 million shares. I'm taking dollars in thousands, and the share price is $4.7. So this gives you the market value, 37,600. So the 4.7 is given in the question. I've picked it from the question. You can see in the first line, immediately beneath the balance sheet, that it is 4.7. Okay, and then the market value of the bond, is given in the question, which is 104.5. And the redeemable preference and the preference shares market price is 40 cents, $0.4. The preference shares are not redeemable, they are irredeemable. Remember the question we did, the cost of the preference shares in the previous question, they were also irredeemable. The same way we'll get the cost of preference shares over here. Okay, and the bank loan is a term loan, that therefore we don't need to calculate its market value. Its face value will be equal to its market value. So let's calculate the market value for the rest of the items. The preference shares are of 3 million. So 3 million multiplied by 0.4. Then redeemable loan notes are 3 million, but they are of one loan note is of 100. So we have to divide it by 100. So 3000 divided by 100 gives you the number of loan notes, and then multiplied by 104.5. This gives you the market value. So there you go, you get the market value of 3 items, and the market value of the 4th item is same as the face value, which is 1000. So the total market value of all the items is 42935. This is the total value. Now moving on to the cost of equity. Now which method will we be using for calculating the cost of equity is the dividend growth model again, because you haven't been given any risk-free rate or market rate of return or the beta over here. Again, you are being shown the dividends in the question. So over here also we'll be using the dividends only. So what is the dividend in this question? First find out the latest dividend. The latest dividend is 36.3 cents, and the previous year dividends are this much, so 8, 9, 10 and 11. Right now, in order to use the dividend growth model, you need to know the growth rate. So you have to calculate that by how much these dividends are growing. So we use a geometric average method to calculate the growth rate, right? So in how many years the dividends has grown from 30.9 to 36.3? In how many years? This is the first year, second, third, and then 4 years. So it's 4 years in which total there are 5 dividends, but in 4 years they have increased from 30.9 to 36.3, right? So let's first calculate the growth rate. So G is the growth rate, and this is equal to the latest dividend divided by the earliest dividend, right? latest dividend divided by the earliest dividend to the power is 1 upon n, which is 4. N is 4 in this case because the dividend has have increased in 4 years time. So 1 divided by n. So it has got difficult for me to make the brackets this case. Okay, and then minus 1. So that's the formula. So we'll put the latest dividend, which is 36.3, and divide that by 30.9, which was the earliest dividend, and we'll put on the power one upon n, 1 divided by 4, and then we'll deduct minus 1. So please solve this on your calculators, everybody, to arrive at the growth rate. So doing this, you get a growth rate of 4.1%. It must be 0.041, but it makes 4.1% the growth rate. Now, using the dividend growth model, the same formula as we used in the previous part, the dividend we have right now is 36.3. So 36.3 is the dividend multiplied by the growth rate 1.041 to the power. Okay, and this gives you the dividend divided by the market price. X dividend market price should be used, which is 470, and then plus the growth rate 0.041. So this gives you the cost of equity, which is 12.1%. 0.121 multiplied by 100, which is 12.1%. So that's the cost of equity, which has been calculated using the dividend growth model, the same formula we used above, this one. This formula has been used to calculate the cost of equity. Okay, now moving on to the cost of equity is 12.1%. Moving on to cost of preference shares now. So what's the cost of preference shares? The same formula we used in the green patch in question number 2. So let's use the same formula for the cost of preference shares. So cost of preference shares irredeemable as per question. So we'll use this formula to calculate the cost of preference shares, and it is 4% preference shares. So 0.04 is the interest. It's a $1 preference shares. So 4% of $1 will make 0.04 interest, right? And there is no tax saving. So we will remove the tax saving from here. So if you are using a preference shares, you won't save tax on it. So for a KP stands for cost of preference shares. You will just be taking the dividends divided by the market value. You won't take the tax shield. That's the difference. In case of cost of debt, what you will do, you will, if it is irredeemable, you will multiply the interest with 1 minus tax rate, as you are getting the tax shield. In preference shares, you won't be getting a tax shield, right? So the cost of preference shares can be higher because you do not attract a tax shield over it. So dividend divided by the market price. So 0.04 divided by its market price. The market price of the preference shares was 0.4. So this makes 0.04 divided by the market value, and this gives you 10%. Multiply this by 100 to arrive at the 10% rate. So there we go. So the cost of preference shares has been calculated to be 10%. Next is cost of debt. But before going on to the cost of debt, let me calculate the cost of the bank loan first. So cost of the bank loan, they have not okay, the cost of bank loan. Okay, I'm doing it over there only in that schedule. It's easy to do over there. So the cost of the bank loan is at 4% average interest, and the tax shield will be 70%, 30%. So the net cost is 70%. So what we will do, we'll take 4% multiplied by 1 minus the tax rate, 0.3. Now the bank loan is also irredeemable. They have not given you the time. So if it is irredeemable, then we will be using this formula. The formula is interest multiplied by 1 minus t. So this is only in the case of what? This is in case of a redeemable borrowing. Interest 1 minus tax rate. When you will be using this formula, interest into 1 minus tax rate. So in case of this is we are using in the case of a term loan. The important thing is that this is a term loan, bank loan. So this makes a cost of debt of 2.8%. Now, what about this cost of bond, which is a 7% cost of bond? For this, you have to calculate the IRR, internal rate of return. In case you have a market value of the bond, which is 104.5, different from the face value, right? So in that case, you will have to calculate the internal rate of return. And if the bond is redeemable, if the bond is redeemable, remember, and the face value and the market values are different, in that case, you have to calculate the internal rate of return. So cost of the bonds that are redeemable is calculated as follows. It is IRR, internal rate of return. We will calculate the internal rate of return. So for internal rate of return, we will have to calculate two NPVs, two net present values at two different rates connected to the bond. So first, what will we do? we'll doing the NPV calculations to calculate the IRR. So the bond duration is 6 years. So at year 0, the investor will purchase the bond at market price, right? The investor purchases the bond at the market price, which is 104.5. So the investor pays 104.5, that results in an outflow. Then the bond's life is 6 years. So still 6 years, he will be receiving interest on the bond, and the interest is 7%. But you will take interest net of tax, which is 30%. So 7% into 0.7, 1 minus t. This gives you 4.9. So always the interest will be taken as 30%, as there is a tax payment on the income. And then once the 6 years are over, there will be redemption of the bond, and the investor will get back his money, which is the redemption amount is 105. In this case, you will get 105. All of this is given in the question. Let me show you first. Okay. Looking at the question, the 7% bonds are redeemable at a 5% premium. So 5% premium means the bond will be redeemed not at 100. They'll be redeemed at 100 plus 5, which is 105. So the investor after 6 years will be able to receive how much? 105. This is an inflow for the investor, right? But right now, what the investor will pay to obtain this bond, to acquire this bond, he will be paying 105, which is minus. And then there is a 7% bond on which there is a 30% tax rate. So interest will be 7 multiplied by 0.7, which is the remaining income after payment of tax. So that's the cash flow. Now we will calculate the present value at two different rates. So let's take present value fraction, first one at 5%. You can take any two rates. At 5%, the present value fractions will be as follows. You can calculate it afterwards, or you can check from the table. These are at the 5%. So this gives you the present value at 5%. So the present value at 5% will be cash flow multiplied by present value fraction. These will be the present value, and you get the NPV now. The sum of the column is the net present value the net present value is 1.3 minus. Now, as it is a NPV is a negative one, you will reduce the rate, take a lower rate, so that the other NPV which will be calculate will come positive. So take another rate, suppose 4%. Take a 4% rate, a lower rate, and calculate again. Calculate the present value workings again. So at 4%, the present value fractions will be 1, 5.242, and 0.790. These will be the present value fractions at 4%. So now you get the present value at 4%. So the present value become minus 104.5, the investment amount, which is immediately payable. Therefore, the present value is full. and then 25.69 is the present value of interest received, and then the present value of the redemption amount. So these are the cash flows associated with the bond. What cash flows will the bond holder receive? So he will first of all purchase the bond, resulting in an outflow. Then he will be receive interest for the duration of the bond till 6 years, and then he will be receiving the redemption amount. So we have taken these three cash flows. So now the NPV comes 4.14. So we get two NPVs, right? One is NPV at lower rate. NPVL is the NPV at lower rate, and one is NPV at higher rate, which is 5%. NPV at lower rate is 4%. So what's the formula for IRR? The formula for IRR is lower rate plus NPVL, NPV at lower rate divided by NPVL minus NPV at higher rate, and then multiplied by higher rate minus lower rate. This is the formula for the internal rate of return. So using this formula, the lower rate selected by us was 4%, and then the NPV at the lower rate was 4.14, and 4.14 minus the negative NPV make the positive NPV. Minus minus, it gets plus, and then five minus 4. This gives you the internal rate of return. Now use your calculators to arrive at the internal rate of return. So the rate of internal rate of return makes 4.8%. It's 4.8%. So that's the cost of bond. So there we go. We have now calculated the cost of all the four items of financing received by the company, AMH, and we have also got the market value. Now we will take the average of these four. Right, so let's take the average, and that average is known as the weighted average cost of capital. So let me calculate the weighted average cost of capital now. Okay, doing it here, you will be able to see the weighted average cost of capital calculation in red over here. The WACC, weighted average cost of capital. So the weighted average cost of capital is using the market values, we'll calculate the weighted average cost of capital. So it's 12.1% is the cost of equity. This will be multiplied by the market value 37,600 divided by the total 42,935. Then we will add the cost of preference shares. So the cost of preference shares 10%, 10 multiplied by its value, which was 1200, divided by the total market value of all funds, 42,935. So one by one we will do it. We will multiply the cost of each finance source with its market value and divide by the market value of all items. So first take the cost of equity, multiply it by its own market value and divide by the whole market value of all items. And then cost of the preference shares multiplied by the market value of preference shares divided by the market value of all. Then the third item was the 7% bond, 4.8% was the cost, multiplied by its market value, which was 3135, divided by the market value of all, and then finally the bank loan. The bank loan had a cost of 2.8 multiplied by its face value 1000 divided by the 42935, the total market value. This gives you the WACC. So the WACC in this case, please use your calculators. It is around 11.3%. This is the WACC calculation. Okay. Yes, cost of preference shares is dividend divided by market value if the preference share is irredeemable. No, you don't need to write the formula. If you know that accurately that the formula you are using right, you don't need to write the formula. You'll get the marks. Examiner knows the formula, right? Market value is not negative. Actually, when you Sohail, when you buy the shares, what happens? If when you buy the shares, the cash uh, will flow out of the bond buyer, bond buyer's company, right? So you will be having a cash outflow. So it has been taken as a cash outflow, and when you redeem it, you will be receiving the cash again. Huh. So why IRR for cost of bonds? There is a question. Is a good one. Advait asks that why IRR for cost of bond and not for cost of loan. Listen, when you will be using the IRR, IRR will be used when the life of the bond is more than 1 year and the bond is redeemable. Life is more than 1 year and the bond is redeemable, and the face value or market value are different. Otherwise, no need to use it, right? So in case of the bank loan, the face value market value are equal, right? Secondly, it is irredeemable, so you can't use the IRR. So in order to know the IRR, you have to take life over there, like 1 to 6 year interest. You won't be able to calculate the IRR in that case, right? So that's why we have not calculated IRR for the bank loan. Clear, Advait? And one more question. Okay, can't we net of preference shares cost with tax? No, you can't net it. Preference shares will be having dividend always, and dividends do not attract a tax shield. So that's never deduct a tax from preference shares in order to arrive at the preference shares cost, right? Okay. So cost of preference share is simple, Kamran. Just divide the dividend, which is 4% of $1. $1 is the preference shares face value. So you'll get 0.04 the dividend and divide it by market price, which is 40 cents. So 0.4 is the 40 cents in dollars. So 0.04 is in dollar, divide by the 0.4 in dollars. So Rida, your question has been also answered, right? You won't do 1 minus T for preference shares cost. Huh? That only will be done for a cost of debt. Why we are taking 470 as X share value? 470 is already, if they have not told you that they have given you the X dividend market value in the question. If you can see on the left, they have told you that it's X dividend market value. So if they have not told you anything about the X dividend or cum dividend, you will assume it as X dividend, right? Okay. Okay. Yes, I've taken 470 as a market value of equity because dividend is also in cents. If dividend is in cents in the dividend growth model formula, then you will take market value also in cents, right? So uh, it needs to be understood that the numerator and denominator both should be in cents, or otherwise both should be in dollars. If I would have taken the dividend as 0.36, 3, then I would have divided by 4.7 in dollars, right? Okay, so I hope I have answered the questions. I have answered the most of the questions. Now let's see part B. Look at part B now. What do they ask in part B? Then there is a long discussion on it, and I will be discussing that through some points, which I will show you in a 1 or 2 minutes. Please wait for a 2 minutes time. Okay, let me share the discussion with you. Okay, okay students, I will be shading the area one by one when I discuss the points. Look, first of all, in capital asset pricing model, in a capital asset pricing model, the CAPM, the cost of equity is equal to risk-free rate plus beta multiplied by RM, the market rate minus the risk-free rate, which is also known as premium. So this is your formula for the CAPM. So you are watching the formula in yellow. So I'm shading one by one the material which has been written on the screen in yellow. So first of all, the CAPM gives you the cost of equity using this formula, risk-free rate plus beta, and beta represents the risk. So what happens that this RF, the risk-free rate, this is the rate at which the investors will invest in an investment without any risk. So suppose this is 4%, 10%. What does this mean? Return from the market portfolio is the return from a well diversified portfolio where the non-systematic risk has been diversified. Only systematic risk remains. So 10% is the return from a not of a very well diversified portfolio, and 4% is the risk-free rate. Means 6% is the rate by which the return exceeds the risk-free rate, and the investors wants 6% more for a well diversified portfolio of ordinary shares, right? And the beta is the risk factor. Suppose the beta is 1. In case of beta is 1, the cost of equity will be equal to 10, the market return only. But if the beta is 1.2, means the investment you are seeking to invest in has a greater risk than the market portfolio. So you are seeking a better rate also on it. So the rate that you will be seeking will be 6 multiplied by 1.2, which is 7.2, plus 4, which makes 11.2. So the return from the market portfolio, which is a well diversified portfolio, is 10%. But you are asking for the return on a particular share at 11.2%. Why? Because that share or that investment or that project is more riskier than the market portfolio, right? So beta more than 1 indicates that the investment you are seeking to invest in is more riskier in terms of systematic risk compared to the well diversified portfolio. But if the beta is 0.8, this means the investment you are seeking is less risky than the market portfolio. So over here by 0.8 means 4.8 plus 4, 8.8 will be the cost of equity. So the cost of equity depends on the risk being investing in a particular project, right? So this is what the capital asset pricing model teaches you. And the market portfolio is always riskier than the risk-free rate, and the market portfolio will ask for at least how much. A market portfolio is a well-diversified portfolio where all of the non-systematic risk has been put out. So 10% is being asked for a market portfolio. So if an investment is more riskier than a market portfolio, then the beta will be greater than 1. Otherwise, it will be less than 1. Okay. So that's the basics behind the capital asset pricing model. Variability means the changes that will occur in profit due to change in conditions. Variability means the profit will not remain same. Like for example, there is a business in which the profit today is 3, but 3 per share. But in the next year, when the economic conditions are worsened, then the profit gets 2 per share or 1 per share. So that's a variability. But in case of loan notes, you will get the same amount of interest every year, irrespective of the profits earned by the company. And if you invest in a government share, in a government treasury bond, you will get a better interest, more smoother interest. So it's a risk-free investment. So it's a variability which reflects the risk. By risk, we means the variability, the expected changes and the fluctuation in the profits which the investor will receive. The more the fluctuation which the investor expects from the shares, investment in shares, the more will be the risk and more compensation he will be asking. And the investor makes a combination of investments in order to reduce those fluctuations. So invest in negatively correlated investments to make a market portfolio, well-diversified portfolio. Ibrahim, I hope you have got the answer, right? So let's move on to the further discussion and complete the discussion at least before ending the class, today's class. So students, let's move ahead. Now what happens? The beta in the CAPM represents 2 types of risk: the operational or the business risk. Operational risk means it's defined here, the business risk. Variability in profits due to changes in the conditions in an industry. And the other one is financial risk, which is variability in profit due to the financial structure of the company. Like, what do we mean by variability of profit due to financial structure? By financial structure, we mean if you borrow more, you will be having more interest. So if you have more interest and the profits level is low, no dividends. But if you have more interest, the number of shares will be low, means you are borrowing more. So less equity investments, less number of shares, and if the profits are very high, so after payment of interest, which is fixed cost, you'll be left behind with a lot of profits, net profits. So they will be divided in less number of shares. So when profits are low, high interest will lead to no dividends or less dividends. And when profits are very high, the fixed interest will lead to a lot of savings, net profit, because the interest will not increase, but the profits would have very much increased. So less number of shares to be divided amongst the number of shares amongst with the profit, net profit will be divided, the high profit will be divided. So it will give you a very high EPS. So there is a fluctuation in earnings per share. It is what talked about here. So due to interest, the fluctuation can be very high when the sales is fluctuating and the profits are fluctuating. So this is known as financial risk. And in case of operational risk means due to the change in conditions in the economy, the sales of the business fluctuate, due to which the profits fluctuate. So that's operational risk. So primarily the profit of the business fluctuate due to the conditions in the economy and the industry, right? And then secondly, once the profits and sales in an economy fluctuate, the interest will further affect the variability. If you have borrowed a lot, if you borrow less, then no interest. Then even some profits you have and you don't have any interest as you are ungeared will be resulting in some EPS, which in case of a company that borrows very high will having high interest, and it won't be left with any net profits after paying interest to its shareholders. It won't be able to give any EPS to its shareholders if the interest is very high, if they borrowed very high. So there are two types of risk: business risk and the financial risk, which are present in the beta. More financing through debt capital will increase gearing and therefore will increase the financial risk. And the variable in profit due to changes in the sales in an industry is this business risk. So students, that's the definition. Beta includes two things, right? The business risk and the financial risk. The variability in profits will arise due to these two things. Okay. Now, the next point regarding the beta. Let's suppose a company is operating in a textile industry. Okay, let me shade together. Now we have covered this area till now. And now this is an example. Let's suppose we are planning an investment in a project which is in textile industry. So suppose a company is operating in a textile industry and now it is evaluating whether to invest in an automobile company. So there is a question: will the risk in the textile industry and the automobile industry be same? The company's existing beta cannot be used to calculate the K, as the business risk phase due to textile and other segment is different. So beta change due to change in business. If the business change, the beta will change. So if beta change, the cost of equity will change according to the above formula, and the WACC will also change. So what do this mean? That all projects you are planning to invest in will not be discounted with the same discount rate. The discount rate for different projects in different industries will be different. So it is important to note that cost of equity depends on beta, and the beta for different industries will be different. So you will have to use different betas for different industries. So this is what the question is asking for. So now, how will you calculate? Let's end today's class and we'll continue from here tomorrow. Let me take some questions if people have. Yeah, ups and downs in the profit is fluctuation, Ibrahim, and that can be taken as risk, because you cannot make an expectation regarding future due to the fluctuation in the past. You don't know what is going to happen in the future. Okay, beta is basically based on a historic research, and they use in order to calculate beta, they use standard deviation calculations. So which is not basically how to calculate beta is not in our syllabus. It will be covered in P4 in the advanced financial management syllabus. So you can calculate the beta using the standard deviations and the variances, right? Okay, so these were the questions being asked. I hope I have covered all the questions. Okay, so thank you very much for attending the session day 2, and thank you ACC for giving us opportunity, me to teach and you to learn with me, and see you tomorrow with the cost of capital, and the new topic will be business valuations tomorrow and financing as well. Business risk will, yeah, if there is no business risk, obviously the EPS will not change, it will remain same. So it is due to the change in the sales which affects the operating profits and the EPS as well. You are right, Rohit. Okay, so see you tomorrow. Goodbye. Have a good night.